It's March, so let's look back on February to see what's up and down with housing and lending. This month we'll start with the key takeaways for February. The U.S. economy continues to improve, but it is slowing, and that is creating a neutral impact, especially with higher gas prices. Jobs continue to improve, and that's very positive. Savings is still declining slightly. Inventory is also declining, and that's a positive for housing prices. Valuation, though, is still declining. That's a negative. In terms of a future, the housing is stabilizing, but prices may take longer to respond. Investors are paying cash now to get bargain prices and move quickly. New buyers, the mass affluent, they aren't as affected by stock price appreciation, and we're seeing that they're still waiting for house prices to improve. Overall, a bottom is forming in housing. That's good for housing, but we really may have a way to go as it relates to seeing that flow through onto the balance sheet of most Americans. So we'll start with our big picture look at the general market. It's interesting when we look at this chart from Bianco Research. If you think about short-term memory, since 1933, real nominal house prices continue to go up and up and up and up. So you can imagine how many people just simply felt like it was impossible for house prices to go down. It wasn't until the 2006-2007 period where house prices started to decrease, and that led to the current challenges. Only two markets, Phoenix and Miami, showed any positive real price value in the prior month. These could be canary in the coal mines because these are two of the worst markets in the U.S. They could lead prices back if we see a continued uptick in these areas. We see on a real housing price basis that we're still back at around that 1998 level. We could see a further drop here to test the support line. The NAR says we're running at about a 163.5 median house price. That means about half the prices are above this in the U.S., about half are below. We can see this differently as we look at that prior decline in the 1930s and then the decline here in 2006. We could be setting up here as house prices start to stabilize for a move up. So that leads us to where are we now? The Dow breaks 13,000 but doesn't hold. The market's getting nervous. That could create a thrill ride for us in either direction. Overall, the S&P is up almost 9% for the year, but we see housing making a steady recovery, but prices are still sliding. Again, you see the higher net worth people affected by stock prices increasing. You see more of the mass affluent more affected by house prices increasing. So are we better off than 5 years ago? We actually saw disposable income drop by almost 1% over the last 5 years. The average American has about $37,000 in disposable income. This is the first time since World War II that we've seen real income declines over a 5-year period. That's affecting savings rates. What little cash and cash flow people have continues to be focused on debt reduction. We saw aggregate consumer debt fall again slightly in the fourth quarter. We're down to about $11.53 trillion in overall consumer indebtedness. Mortgage balance dropped by $134 billion last quarter, and HELOC balances fell by $12 billion last quarter alone. A bright spot has been unemployment. We saw claims drop to 358,000. We can see that the 4-week moving average now is below 400,000 monthly. That's the lowest level since May of 2008. Very positive for the markets. We see the yellow line here is showing job openings, and that number is continuing to increase. We're also starting to see hirings increase, and we see here in the blue lines the number of quits is starting to stabilize, as are the number of layoffs. Again, very positive for jobs as a whole. Having jobs equals income, income equals servicing that debt. That helps to stabilize the foreclosures and increase the property values over time. This shows a great correlation. You see housing starts here. You have the level of unemployment here. You can see this is inverted, so we're seeing unemployment drop. It's going upwards here below 8, and we see it wanting to move towards 6. As that unemployment has started to tick up, we're starting to see more and more housing starts. So existing home fell again to a 6.1 month supply, down from a 6.4 month supply, and we continue to see a positive trend up in existing home sales. Now this is a wonderful slide from Calculated Risk. You saw that in the prior downturn, the bottom for residential investment as a percentage of GDP, meaning people started investing and buying houses again, was in 1991. However, prices didn't bottom till almost 5 years later in 1996. So that's where we're seeing that housing could be forming a bottom here, but will it increase house prices, which is what so many Americans are watching for, to go back and buy new properties again. That said, many markets are at 5-year lows for inventories. The inventory of completed home sales dropped again to 57,000 units in January, the lowest level ever recorded in the series. When we look at foreclosure inventory by state, the shadow inventory, that is still a concern. We're seeing the general inventory drop, which is very, very positive. When the inventory gets really low, supply and demand kick in, we see prices increase. But that could lead to a flood of the 2.1 million estimated properties coming back onto the market and creating a backlog and seriously impacting the overall supply. We see real estate owned by the FHA continuing to decline. We see real estate owned by Fannie Mae continuing to decline. We see overall mortgage delinquencies and foreclosure on a 30, 60, and 90-day continuing to decline. Now, here's one of the big challenges with shadow inventory. The judicial states that require the courts to process the foreclosure paperwork, as you can see on the left here, are in red. These are the large states where the majority of the foreclosure property is expected to come from on a shadow inventory basis. The non-judicial states have done a much better job of keeping up with the ongoing foreclosure business or volume. So let's look quickly at how the consumer might be viewing some of these things in their local community. Consumer sentiment did tick down. We saw a move from 75 down to 72.5. The overall sentiment is weak, and again being affected by things such as the stagnant home prices and the increase in gas prices. One extreme positive has been mortgage interest rates. The 30-year fixed rate mortgage hit 3.87% on a national average. That's with 0.8 points in February of 2002. That's down from 3.98 in the prior month and down from 4.81% in the prior year at the same time. From a consumer perspective, we're starting to see home sales continue to pick up. When you see houses on your street starting to sell, it makes you more optimistic. The monthly median price has started to stabilize. We can see here that the prices are stabilizing, and this gives people a feel that maybe it's time to go back into the water. While they're seeing the prices start to stabilize, there's still a question over whether or not now is a safe time to buy. They're seeing home inventories continue to drop. Many people, albeit they can't sell their house today, are finding it very difficult to find a new property because the inventories are so low. Eventually, that'll put a positive price appreciation spin to the market. Now, this to me is a really interesting graph because we see the market sell-off and the bottom in properties as well as in the overall market back in 2009. But as you can see here, we've seen a complete recovery now, and those stock prices have come back to almost the prior market top in 2007. Yet as we see below, home equity has actually dropped back below that 2009 low. So if you're a wealthier consumer and you can afford to wait, you see a positive appreciation in your overall assets, whereas for the middle class, a vast majority, for many Americans, 2/3 of their wealth is inside the house, and they're looking for those house prices to start to increase again for them to become more confident about their real estate. There's quite an opportunity for cash buyers today. 31% of all residential home sales in the prior month were cash purchases. We think this is a reflection of investors buying with a longer-term hold in mind. You can see this reflected both at the investment property level and at the second home level. We're also starting to see this play out again through rent rates, as we see that on a CPI basis, rent went up 2.4% in the last 12 months. The first time we've seen a solid, stable rent increase since back in 2004. This is a perfect storm for the investor because what they want to see is vacancy rates continuing to go down, as you see here, while property rental rates are continuing to go up. We had seen a consistent downturn in distressed property, but in the prior month we saw a 32%, so we saw an increasing amount of foreclosure and short sales. This could be part of that REO inventory starting to work its way back into the market. There's a saying in the stock market to sell in May and go away, meaning most of your price appreciation happens by May of the year. In the real estate business, it's actually the opposite. You want to sell by May or go away, because we often find that most of the sales volume, we'll see it peaks out here, annual sales by month, in May, finally in June, and that's when we see things start to taper off throughout the rest of the year. So if you're thinking about listing or selling that property, the best time to do it historically is between now and May. Your odds start to dwindle throughout the end of the year, hitting their lowest point in December and ultimately in January. So that's our look back on February. We see overall, we'll give the U.S. economy the benefit of the doubt. It's neutral, but it's improving. Jobs, definitely a positive that we can continue to look forward to. When we look at savings, that's been declining, and most of the savings has been going towards repaying some of that outstanding debt, which is positive longer term, but more difficult short term. The inventory is dropping. That is a positive, but again, we see valuations aren't reflecting that. Prices are still going down. So overall, we'll say that in general, housing is stabilizing, but prices may take longer to respond. Investors really have the upper hand right now, paying cash to get bargain prices. Overall, though, the mass affluent who are more affected by property values and stock prices simply aren't seeing the momentum that they want. But we'll say in general right now the bottom is forming in housing, but we just simply have a ways to go.